Warren Buffett is sitting on $300 billion in cash, and every financial headline you've read about it is wrong. Not incomplete, not oversimplified. Wrong. Most finance channels will tell you Buffett is scared, that he's waiting for a crash, that he doesn't like anything at current prices. That's lazy journalism dressed up as analysis, and it completely misses the actual strategy being executed at the highest level of capital allocation on Earth. When I went through Berkshire's shareholder letters and ran the actual yield math, what I found was not fear. It was a precisely engineered capital position generating more annual income than most S&P 500 companies produce, while carrying zero equity risk. This is the framework. And once you see it, you can't unsee it. Stay with me, because what I'm about to show you changes everything. By the way, if you're new here, my name is Alex Carter. I've been working in personal finance for 8 years. In these 8 years, I've helped hundreds of people solve real money problems. And honestly, some of those people's lives completely changed because of it. On this channel, I help everyday people read between the lines of what the smartest capital allocators in the world are actually doing and apply those principles at any portfolio size. All right, let's get into it. My situation a few years ago was this. I had a client, high-income professional, mid-40s, managing a $740,000 personal portfolio, who called me frustrated because he was sitting on $180,000 in cash and felt like he was doing something wrong. The market was near all-time highs. His advisor was pushing him to deploy. Every financial media outlet was telling him cash was a drag on returns. He felt guilty about his cash position the same way someone feels guilty for not eating when they're not hungry. And then I showed him what Buffett was doing and why, and the conversation completely changed. Okay? Let's start with the $300 billion number in actual context. Berkshire Hathaway's cash and T-bill position reached approximately $325 billion in 2024. That is the largest cash reserve ever held by any single company in history. And the financial media responded to this with one question. When is Buffett going to deploy? That is the wrong question, and it reveals a fundamental misunderstanding of what that cash position is actually doing. Here is the math that most financial commentators never ran. At a 5% T-bill yield, which is approximately what short-term treasuries were yielding when Berkshire's cash position peaked, $300 billion in T-bills generates approximately $15 billion in annual risk-free income. $15 billion per year. Risk-free. For context, that is more annual profit than Ford Motor Company, Goldman Sachs, or American Airlines generated in their best recent years. Berkshire's cash position alone, the part everyone is calling lazy and fearful, is producing institutional-scale earnings with zero business risk, zero equity volatility, and complete optionality to deploy at any moment. That is not fear. That is a weapon. Okay? Keep watching, because what comes next is the part most people never figure out, the actual framework Buffett uses to decide when cash stops being the best asset. And here's the thing nobody tells you. Buffett has explained this framework in his own words repeatedly in his shareholder letters. Most financial media doesn't read the letters. They read the headlines about the letters, which is exactly why the narrative stays wrong. The framework is the opportunity cost equation. Buffett only deploys capital when the expected return on a business investment clearly and materially exceeds the risk-free rate available on cash. Not marginally exceeds, clearly and materially. When T-bills yield 1%, as they did between 2010 and 2021, almost any reasonable business investment beats that hurdle. Cash is genuinely a drag in that environment. Deploy aggressively. When T-bills yield 5%, as they did in 2023 and 2024, the hurdle rate moves dramatically. Now, a business investment needs to reliably return 8%, 10%, 12% to justify taking on equity risk when you can get 5% guaranteed. At current equity valuations, finding businesses that clear that hurdle with confidence becomes extraordinarily difficult. This is not complicated. The math is simple. People just don't want to sit with the implication, which is that sometimes the highest returning asset available is cash. Okay, here's where it gets interesting. The CAPE ratio, the cyclically adjusted price-to-earnings ratio developed by Nobel economist Robert Shiller, measures equity valuations against a 10-year average of earnings to smooth out business cycle noise. As of 2024, the U.S. equity market CAPE ratio was approximately 34 to 36. Historically, a CAPE ratio above 30 has been associated with forward 10-year real returns of approximately 0% to 3% annually. Not 10%, not 7%, 0 to 3%. Now compare that to a 5% risk-free T-bill return. If historical relationships hold, and they have held remarkably consistently over 100 years of data, cash in T-bills is currently projected to outperform equities over the next decade. Not because of fear, because of math. Buffett knows this. He has referenced the CAPE ratio framework in multiple letters. He has explicitly stated that he uses current interest rates as a critical variable in his valuation discipline. And yet the narrative remains. Buffett is scared. Buffett is waiting. He's not waiting. He's winning, right now, with cash. Okay? Stick with me. This next part is where everything changes for what this actually means in your portfolio. This is the part most people completely miss, the Berkshire buyback signal. When Buffett cannot find businesses to buy at prices that clear his return hurdle, he buys Berkshire stock. Share buybacks are Buffett's explicit signal that he views Berkshire shares as undervalued relative to intrinsic value, and therefore as a better deployment of capital than available acquisitions at current prices. In 2020, 2021, and 2022, Berkshire repurchased approximately $27 billion of its own shares. In 2023 and into 2024, buyback activity slowed significantly because even Berkshire shares reached a price where Buffett determined the return hurdle was not clearly cleared. Read that carefully. When Buffett slows buybacks of his own company, the business he knows better than anyone on earth, it is a precise signal that he sees very little value anywhere in the current market at current prices. Not fear, signal. And there is a significant difference, okay? So you're probably wondering, what does any of this mean for someone managing $100,000, $500,000, or $1 million rather than $300 billion? The translation is direct. First, reframe how you think about cash. Cash is not laziness. Cash is not failure. Cash held in T-bills or a high-yield savings account at 4.5% to 5% is an actively returning asset. If you have a cash position earning 5% and you're feeling guilty about it, you're applying a zero-rate mental model to a 5-rate environment. Update the model. Second, apply the opportunity cost equation to your own deployment decisions. Before you move cash into any equity position, ask one question. Does this investment clearly and materially beat the 5% I'm getting risk-free? If the answer is yes with confidence, deploy. If the answer is maybe or probably, hold. Buffett's entire discipline is embedded in that question. Third, understand that patience is a return. Every month your cash earns 5% is a month you're ahead of an equity market that the historical data suggests may return significantly less than that over the next decade. Patience in a high-rate, high-valuation environment is not a cost. It's a compounding advantage. You have agency, more than you're willing to accept right now. The same capital discipline Buffett applies to $300 billion applies identically to $300,000. The scale is different. The framework is identical. Okay? All right. So today we covered what Warren Buffett's $300 billion cash position is actually doing, why the mainstream narrative is wrong, and how to apply his exact opportunity cost framework to your own portfolio right now. If this helped you even a little bit, hit that like button. It genuinely helps this channel reach more people who need this kind of content. Subscribe to the channel and make sure you hit the bell icon so you never miss a video like this. We drop new finance content every week, and trust me, you don't want to miss what's coming next. And if you want to go even deeper on how to evaluate equity valuations and build a capital allocation framework for your own portfolio, I've linked a video right here. Go check that out next. I'll see you there. Have a prosperous day.